Thank you, everyone, for joining me this morning to the September edition of the afterMATH. We'll dig right into it today because we had some good, surprising numbers to talk about from Friday's report. For those wondering how many samples or how USDA does their sampling, this was included in the report. So I thought this was an interesting map showing the number of samples they get by state. Thought it was interesting. Kansas, the biggest by far, at 605. And then several of the other Midwestern states, not near as many. Texas, all things considered, a big state, maybe not that many surveys. So, can they be skewed? Sure, absolutely. They're not taking a huge amount of physical on-field surveys. Certainly those surveys will carry more weight as we get further in. The special note that came with it as well, that NASS has the opportunity to revise planted harvested acreage in each September. So they did it Friday. So that was interesting that they decided to include this special note. So we'll kick off with corn. Corn, the monster number, 98.7 million planted acres. That went up another 1.2 from last month, which had gone up another whatever from the previous month. So that's a pretty huge number, all things considered, and by far and away the biggest increase we've ever seen from the June survey. So what does that mean? Is the June survey worthless? I did see somebody suggest that on Friday, that why even come out with that June survey? Why don't you wait until after the certification's done at the FSA office? Which even then is even surprising that they were adjusting from August to September, considering that by August you should have all those certification numbers through the FSA office. So we'll see how they end up in January, but certainly this was a big, big surprise. And when you look at StoneX actually compared the August to Sep, showing, really from when the certification was done, this is still the biggest chump we've ever seen. So pretty interesting to say the least. So where was the increase from August to September? You can see here in the chart on the left, just about everywhere saw an increase in some acres. Overall, we were up 1.5 million, and the number on the right shows since June. So we only had a couple of states or so that had a decrease since June. It's just about everybody else, especially like Kansas, up 10%. So some big, big jumps, to say the least, in the acreage numbers. And so if you want to compare to last year, pretty good chart here showing where the changes were. The Northwest, certainly from a percentage standpoint, as well as the Mid-South and the Delta. The Delta states, percentage-wise, saw a big jump as well. Just Illinois, Iowa, there's 1 million acres right there. You got 1 million in South Dakota. So just about everywhere grew more corn this year. And, it's kind of a surprise to me a little bit when you think about profitability. A year ago at this time, a lot of people in Congress were talking about trying to pass bills to help producers be able to pay their input costs. And now we ended up planting, 9% more corn acres despite high input costs a year ago. So kind of interesting, but maybe that's what the market was trying to tell us. So again, compared to the last 100 years, you can see here we were this year 98.7, 1933, the last time that we planted more acres of corn than we did this year. So pretty amazing to see that happen despite, again, what we would call relatively high input prices. So flipping to the yield side, what's going on there? Well, corn condition numbers, you can see, and we'll get another report Monday afternoon, but you can see that we've been on a little bit of a steady decline since about the middle of July. That's not a surprise. I mean, that's typical. You can see with most years, of course, the crop does look worse as you get, as we start to dry down and get into harvest. But this year, doing kind of the same thing. Yield at 186.7 would easily be a record if it holds. That was down a little over 2 bushel from last month, but again, still a big, big number. So by state, from last month, you can see the pink all lower than a month ago. So just about everywhere saw a little bit of a dip. Indiana held at 205. A little bit of surprise there. Some of the southern states held as well, or even got a little bit bigger. Overall yield, again, a record at 186.7. The states with a pound sign would be record numbers. So I was talking to somebody Friday from Minnesota, said there's no way we'll hit 199. And I kind of thought Minnesota was one of the better weather, or had one of the better weather summers that we've seen around the Midwest. So we'll see. But we've still got a few more chances to change the number. We've got October, November, and then the final report in January. Compared to last year, of course, another monster crop. We're still way above last year in just about every state. So, we'll see if they make any changes here in some of these subsequent reports. Here's the satellite imagery map that USDA includes with its report. And I think that's in addition to those few hundred surveys that they do on the ground. They also use the satellite imagery. And I think just about everybody this year would say that the satellites probably didn't get it right. Satellites probably did a really nice job of finding the stalks and the quality of the stalk and the amount of greenness. But maybe there are some issues with tip back and some other things that and weight of the crop that maybe the satellites can't pick up on. So again, we'll find out, I think, as we get into harvest over the next 30 days, especially. So production, a record, 16.8 billion bushels of corn. What are we going to do with 16.8 billion bushels of corn? That's going to be the question here as we move ahead. And this number was above all of the trade estimates once again. That had a lot to do with the acreage number going up. But we'll talk about markets here in a second, but it was pretty amazing the day we had on Friday that the markets traded sharply higher despite a sharply bearish report. So when we look at the balance sheet, we've talked all about the acreage number and the yield, production at 16.8 billion bushels. USDA did make a little tweak to last year's ending stocks, increased that a little bit. But a couple of the big numbers here that I wanted to point out. Ethanol right now forecasted at a record high. Exports, they bumped it 145 million bushels to a new record, 2.975 billion. The feed and residual number we should point out at 6.1 billion. And I think a lot of people probably agree that at some point, USDA will lower this yield number, take production down. But I think this feed and residual number is the swag number here on the demand side. You can see that they're up, 425 million from last year. I don't think our animal numbers would justify that. So I think if you reduce production, USDA probably makes a like reduction in the residual number here. So ending stocks can still be above 2 billion. Just depends what the combination of changes are here over the next couple of months. But I don't see the ethanol number changing. I don't think the export number now will change. I think we're proving that the exports are strong and probably here to stay. So good news for us, I think, as we go forward. Average farm price kept unchanged at $3.90. We'll talk about that after a bit when we look at the PLC and the ARC programs. So where can we go from here? Well, this is our stocks matrix once again, using the USDA yield at 186.7, 90 million harvested acres, gives us a 2.1 billion carryout. If you take that yield down, let's say we go down to the early July trend line number at 181, now you're talking 1565 carryout. However, if you add back in 300 to 400 million from a cut in the residual demand, now you're back up to 1819. So I do think that that's very possible. Reading over the weekend, some people talking yields maybe in the back into the 170s. I heard a 175 this morning. So I didn't even go that low on my chart here yet, but maybe we need to consider doing that. We'll see what they do here in October. But again, I think that any yield offset is going to be offset with a bit of a drop in the residual demand. So, but again, you get down below 2 billion. I think that's what's probably needed initially to get a little bump in the market. And so, but I also think that's why the market rallied a little on Friday, because I don't think the market really believes this 186.7 yield. I think the market thinks that it's lower. The question is how much lower. And so looking at the demand side of the equation, it's a pretty good chart showing where we're at here, 2.975 billion, huge number. Far cry from where we were just a couple of years back when see here in 21 and 22, these were the years China bought U.S. corn. Then China stepped away from the market. We were in a real hurt. But also that's when we had $5 and $6 corn. And at $5 and $6 corn, of course, buyers weren't as aggressive. Now we're seeing a lot more buying with cheaper prices. The other big story at the world level in corn continues to be domestic usage in Brazil. Despite the fact that Brazil had another record crop this year, they are doing what we did back in 2006. They are really ramping up ethanol production, ethanol demand. And so you can see here that 20% of their crop now used 20 plus percent as ethanol demand. So that's a big plus for us. It's a big plus for the world for prices. The fact that Brazil continues to use so much more corn at home. So despite this big U.S. crop, despite the big carryout estimate in the United States, the world carryout number is expected to drop this year. So this extra demand that's been built at the world level over the last couple of years is really amazing. And it's kind of the quiet story. You know, we're all talking about production right now. We're all concerned about the size of the U.S. crop, but we continue to see this demand number dip, or the stocks number dip a little bit. And so I think that that's a positive long term for us, especially it's a building number for us. And I think it gives some hope longer term to the corn market as we go forward. So the funds have covered some of their short position. They went from 200,000 short a couple of months back. Now they're only short about 100,000, which is not out of line considering the time of the year as we're going into harvest. I would guess this year that the bins are pretty empty going into harvest. Last year we had a lot more corn moving off the farm going into the fall. This year I would think that a lot of corn's going to find a place to go. I do think that you get up into South Dakota, especially where they added 1 million acres of corn. They're going to see some mountains of corn stacked around the country, I would think. Northwest Iowa, southern Minnesota, that area is going to have a lot of corn stored, I believe, this year. But, the funds wouldn't surprise me to see these people get back on the long side a little bit at some point here. Maybe once you get past the halfway mark in harvest, you can kind of see that they've been typically done that in several years, all but 2023. The funds got back on the long side of the market here as of late fall. So here's December corn. It really kind of reflects a little bit of the buying that they've done. They rallied the market off the August low and gave us a nice little push. You go back and look at this big trend line that we had that started back in April. A couple of things I would point out here. We just never really ever got that summer rally for the second straight year. I know a lot of us count on that summer rally to sell, and we just didn't have that opportunity. If you go back a month ago at this meeting, and even before that in the market report, I had written a column one day, my 2 cents, talking about the place where I would buy corn and the place where I would sell corn. And the buy side was down here in this 385 to 390 area. And that was where we had made our low a year ago. And I had written that and said last month that if we get down in that 390 area, it'd be a good place to maybe buy calls or something to cover what you might see for an indemnity this year on ECO or margin policies. And didn't quite get there. We got to 392, didn't really go any lower. On the upside side, I said that my target would be this chart gap, the July 5th gap from 430 to 433. If you get back up close to that level, I think it's a good place to be locking some stuff in, especially for guys that got to move corn at harvest this year. I think that would make sense. And lo and behold, we rallied to 430 and a quarter on Friday. This morning, we're back down about 4 cents. So we'll see where we go from here. But I do think that this 430 area, I did have December corn in the hot zone on Friday. We had the RSI up in the low 60s. Stochastics had moved up into the 80s. So at least short term, this thing might be a little bit overdone. And if you have to move old grain ahead of harvest, if you had to move something here on the front end, I think this 430 area is a pretty good mark to sell. Beyond that, I think you go up a dime to 440. That's the 200-day moving average. You got your July peak at 442. Beyond that, you probably go back to the next peak at 456 and a half. Those would be some areas that you might want to look at putting some offers in. But if you got to get corn moved here over the next maybe 60 days. Compared to our insurance price at 470, even with the rally, we're still down, what, 45 cents? So percentage wise, we're still down about 10%. So we still could be looking at a lot of potential ECO payments this year, margin, depending on what your county yields end up looking like. So historically, kind of like I showed with the fund positions a minute ago, historically the lows have been tended to be put in here in early August, the last few years, and then tend to rally a little bit into late fall. So the 3, the 5, and the 10-year average. So wouldn't be shocked to see that happen again this year. A lot's going to depend on the size of the corn crop. Carry wise, we're what, 33 cents now, Dece to July. So you do the math on that. What are we, about 6 months, 7 months? You're talking about a little less than a nickel a month. The carry in the market for corn still strong. If you got bin space, it's still, screaming to use it. I think just about everybody agrees with that. One thing to consider, the only true way to earn the carry in the market is to forward sell it. So if we were to go back here, look at the December corn chart, if you rally up to say 442 and the carry's at 30 cents, Dece to July, that's like selling 472 July corn. Might not be bad to take a look at hedging some July corn for guys that are going to put corn in the bin. Same thing here. If you get up into the 450s, now you're talking into the 480s July. So don't ignore the carry just because the market's trending higher. Don't get looking at the nearby. If you got the bin space and you intend to use it, look at locking it in on any kind of a rally you get. Flipping over to soybeans, USDA to give us a little bump in the bean acreage number Friday as well, a couple 100,000 up to 81.1 million acres. However, compared to the June survey, we're still substantially lower. So kind of a big surprise. A couple of these other years, it was mainly due to extreme wet weather at planting time, late planting. And so we didn't get all the beans planted. But certainly a big surprise that we saw as big of a switch this year as we did. Changes from a month ago, you can see here on this chart, Illinois down a little bit. Minnesota, Iowa, Indiana, Nebraska, all up a little bit from last month. Overall, again, up about 200,000 acres. And compared to a year ago, just the opposite of corn. Where in corn, we saw a big increase. Beans saw a big decrease, especially right through the heart of the Corn Belt. Down 8% overall to 80.3 million acres. That was down about 7 million acres from last year. So what's going to happen to the bean crop? Heard this morning someone on Ohio talking about size of the beans so far being extremely small. I think that finishing weather is going to be a difficult thing for the soybean yield at some point. We'll see if USDA eventually recognizes that. But you can see the good to excellent ratings been dipping here since July. This map I saw over the weekend showed precipitation or soil moisture change over the last 30 days, and pretty remarkable right through the center of the Corn Belt, especially some hot spots in Iowa, Illinois, Indiana, Northeast Missouri, on into Ohio, some areas that have had very little to no precipitation over the last 30 days. So I would think that's got to have an impact. We always talk about August being the time that the bean crop is made, and so we'll see if eventually that shows up. Now, right now, the government says 53.5 bushel beans. We'll see if that can hold. That is a record number if we do end up seeing it. Compared to a month ago, here were the changes in the report Friday. Again, the states with the pound sign would have records. So basically, the Western Belt got a little better. The Eastern Belt got a little worse over the last 30 days. And compared to last year, the blue states are all higher. So still showing a lot of these states much above last year. So we'll see if that holds as we go forward. And again, the satellite map shows that the bean crop is in pretty good shape throughout much of the country. But again, that doesn't always tell the whole story. And this August dry weather certainly could have some changes to us. So production at 4.3 billion, bean production's been pretty flat over the last 6 years, all things considered. Acres have changed a lot, yield has changed a lot, but production on the whole, really hasn't had much of a change. The number on Friday was basically within the trade estimates, so nothing to get excited about there, but we did see a nice rally in the market on Friday, so kind of tells you that the funds maybe don't believe all of the bean numbers from USDA. As we look at the balance sheet, we had the higher acreage number, a little bit lower yield, a tenth of a bushel. Production just up slightly, about 10 million bushels. The crush continues to be the positive story in beans. In corn, it's the export number. In beans, it's domestic crush. And we continue to see USDA bump that number. They offset that with a drop in the exports. That continues to be the struggle part of the bean balance sheet. And with the lack of Chinese buying, certainly that number continues to take a hit. Overall ending stocks went up 10 million bushels to 300 million. That's not a huge number, but it is a little bit of a bump. Psychologically, maybe a little bit of a negative number. Average farm price fell a dime to $10. Again, we'll talk about that here in a few minutes. So as we look at the matrix, what can happen going forward? You can paint a bullish picture to beans fairly quick if you want to, because if these numbers hold true, if you take the yield, let's say down to 52.9, and demand stays the same, acres stay the same, now ending stocks drop down to 236 million bushels. So you get down to 52 bushel beans. Now you've got to have a reduction in demand, most likely, because you've got stocks down to 169 million. So again, if you think this bean yield is overdone, you can paint a friendly story here, certainly. And you also, at these numbers, if we see a lower yield, you don't need China, quite frankly, at this point. So, we could do without the extra Chinese demand. And so that, take that all into account. Now, this is something we've seen happening for a couple of years now. We've known it, that here in the United States, that the crush is going up, the exports are going down. We knew that export demand was going to shift to Brazil and to Argentina, and that we're going to use more beans at home. And we've been saying for a long time now that this crush number needs to get bigger quicker in order to offset the loss in exports. And that's basically what's been happening. And so I know there's been a lot of focus on China. I know there's been a lot of concern about what's going on with China demand, with the China trade deal. I would contest, at least at the moment, that we're okay, and that this is not a surprise, and maybe we don't have to have that Chinese trade deal, at least not just yet. So China's been buying beans. You can see their import numbers continue strong. They're just not buying them from the United States, but they've been importing a record number of beans now the last 4 months. So a big shift from where they had been a year or two ago. So apparently their economy's improved. Their hog numbers have improved. Feeding margins have improved. And so they're buying beans. They're just not buying a lot from the United States. However, there was this story that came out on Friday that said that China may have bought some United States beans for January. So that's positive for the market. I think that gave us the rally, or some of the rally on Friday. We'll see if anything else gets announced here this week. The Chinese and the U.S. have delegations meeting in Madrid, Spain today through Wednesday, talking trade. This is their fourth round of trade talks, so we'll see if eventually something gets done. The funds have basically been hanging around zero here in beans. So, really haven't seen a reason to be long, haven't seen a reason to be short. Carryout's fairly snug, so, I don't think they want to get on the short side of beans yet. Here we are heading into harvest, so maybe not a lot of reason to buy them back just yet either. So here's the market. It's, all things considered, we're fairly flat. We've been in a dollar trading range since back in the spring when we had a double top this year around 10.75. We traded a buck lower than that a couple of times. But, here we are kind of in the upper end of that range as of this morning, trading at 10.49 here today. Don't have beans quite in the hot zone yet. RSI at 57, 58, but we're not too far from it. like a month ago, I had suggested you get back up close to this double top at 1074, be a good time to sell beans. Didn't quite get there, got to about a dime from it. So if I got to move beans out of the field this fall, in this 1060 to 1070 area, probably not a bad place to be doing so. We did fill the gap, the July 5th gap here a month ago, so that's been done. Nothing else really to look at here on these charts other than I think we've got some really good support at these long-term moving averages. Here we've traded into those the last couple of weeks a number of times, the 50, the 200, the 100-day moving average, and we just haven't been able to bust the market below those. I just think you run out of willing sellers. So now we're back above the 20-day moving average this morning. We'll see if we can extend maybe another 15, 20 cents and give us a selling opportunity. Compared to the base price for insurance at 1054, we're just basically right there right now. So I don't anticipate payments on insurance policies this year unless something drastic happens to the market or unless you have a yield loss in your farm or your county. But from a revenue standpoint, price isn't really doing much to make that happen. So historically, we do tend to drift a little bit in beans this time of the year, probably because we see some beans get sold off the combine. Then as you get into the end of the year, the first of the year, you tend to see bean prices trend a little higher into February. So beans are a little different cat than they used to be, though, because of the size of the South American crops now. The fact that Brazil, Argentina easily outproduce the United States, we're starting to see these trends in price kind of start to shift a little bit and kind of moderate a little bit. So not quite like corn. We just don't have that seasonality in beans anymore that we do in corn. So the market still does have a reasonable carry in beans, despite the smallish crop, I guess, relative to demand. But we do have to find a way to hold those beans, and the fact that we don't have a lot of front-end export demand, I think, is what's really hurting the bean market at the moment. That we don't have this September-October loading schedule going to China. You're seeing extreme wide basis levels right at the moment in the northwestern part of the belt. I saw stories last week that Dakota's $1.50 under basis right now on beans. So I think, there's going to be a lot of corn stored on the ground this year up there. Probably going to be a lot of beans held as well. We've got some demand up there. You've got some new crushing facilities. We just can't use all the beans at one time. And so without the train program to the Northwest coast, we just don't have a lot of demand. But you do the math, you're still 7 cents or so a month, 7, 8 cents. It's not horrible. If you had extra space, I guess I'd rather use it for corn than beans. Always do. But if you needed to store beans, then, at least we can make some money here. So again, go back to the chart. If I'm going to hold beans and I can sell beans, say at 1060, let's say 1060 on the board in November, if I'm going to store them, now you're talking 1120 July futures. And so if I'm hell bent on storing beans, on the rally, look at selling the carry, lock the carry in and take advantage of the money. Switching to cotton, we really didn't see much change. Saw a little bit of some little bitty tweaks, 9.3 million acres. That was just a small tweak. Yield 861, just a little bitty tweak from last month as well. You can see versus last month, the states that saw changes. So you had a lot of shifting in yields from last month, but overall, just 0.1% lower, went from 862 to 861. Of course, Texas, Georgia, Alabama, those are the big ones. Did see some positive changes in those states. Compared to last year, similar. Those states all got a little bigger versus last year, and that's helping make up for some of the drop in acres. Production-wise, at 13.2 million bales, second smallest crop we've had in a long time. Has a lot to do with the acres, of course. And the production number was actually at the low end of trade estimates. So I think most traders thought we'd see a little bit of a bump from decent weather. USDA didn't do that in this report. And so looking at the balance sheet, at the end of the day, ending stocks were kept unchanged at 3.6 million bales, 64-cent average farm price. Nothing really here positive or negative for the market to trade in that report that we had. Now, what can change going forward if all the The beginning stocks and the demand numbers held constant. USDA still at 861 on yield, 3.6 million carryout. You take yield back down to last year's number at 836. Stocks then would dip into the low threes, and something like that would be a positive for the market. I just don't know that USDA seems like they want to make any drastic revisions to the balance sheet at this point. So the funds still short. Funds still short about 70,000 acre contracts of cotton. I think this is all based on trade. It's all based on China at this point. The fact that we don't have a Chinese trade deal, I think that the trade views that as a huge negative for the cotton market. The fact that we don't have that market open right now. And so until we get that deal struck, the cotton market, I don't see the funds needing to buy. Now, if this week we get a deal done and all of a sudden, China comes in with an announcement attached to that deal, I think you could see the funds cover their short position pretty quick. And so if I were, of course, long cotton, I would want to wait for that. Hopefully that'll happen. You can see the market. It's been really in a downtrend over the last several months. That we've had lower highs each time. We've had lower lows each time. All of the moving average lines still slanting downward. So I think in order to really, really change this trend, you've got to get back above the 200-day moving average, the light blue line at 68.67, which really kind of coincides with the August high. So if you can bust that level, I think you can start to change the mentality of the cotton market. You can get the funds back on the buy side. I think to do this, you probably have to have a trade deal at this point, or you have to have an extreme change from USDA and a crop report. I don't think that's going to happen for now. Wheat. Nothing. The report Friday, the only thing they changed was exports, 25 million bushel increase, took ending stocks down. Not a big deal. In the big picture, average farm price dropped to 510. That was down 20 cents in this report. And I think it really reflects where the markets have traded over the last several months and the fact that we've been making new lows. And the other big story here was that world wheat stocks went up 3 million tons to 264.06. So that was a little bit of a shocker. That was above the trade from last month. We went up 4 million tons. So bit of a surprise there. Now, where's the added stock numbers? Well, the EU, according to Pro Farmer, going to have a record high wheat crop this year, 136.1 million tons. So that's a big part of it. When you look overall at combined stocks to usage at the world level, though, you look at all the major exporting countries, the stocks to usage number just barely going up a little bit. So, we're still just kind of hanging in there. There's no, we're well up off the low in stocks that we had back in 2021. So the market just doesn't have a reason to get too excited right now. Russian prices have dropped too. That's another thing. If you look at the world markets, the Russian market has been dropping over the last month or so. And so they're the big exporter of the market and the wheat market right now. And if their price is going down, ours seem to be wanting to follow along. So the funds continue to trade wheat in the short side of the market. They're short about 90,000 contracts of soft red wheat as of Friday's report. And as you look at Chicago wheat, kind of looks like the cotton chart continues to trend lower. All the long-term moving averages trending lower, made a new low towards the end of last week. Here on Friday, the market rallied a little bit when the corn and the bean markets rallied. We got back above the 9-day moving average. So that's a start. Can we get above the 20-day at 5.25? That's the next target. Then you can look at the August high at 535.5. So we got a lot of stepping stones here, but just not a lot of reason for this market to get up and rolling just yet. I do think that weather can provide some support to the wheat market if we stay hot and dry through the wheat belt into the planting season in October. I do think that could be a reason for reduction in winter wheat acres here in the U.S. and could maybe give some support to the wheat market, but that's still going to be a month or so out. Kansas City wheat, funds short about 50,000 contracts. So biggest short they've had on this date. Found some support right about the $5 level. We're up off that level, but again, you've got a lot of hurdles above us. We'll see if the wheat market can get any can extend at all. In spring wheat, same thing. Funds short about 25,000 contracts through Friday. And you look at the spring wheat chart, very similar to winter wheat. We're just trading near the lows here at the moment. So, again, we need something to trigger, whether it's export buying, whether it's a rally in the Russian price, whether it's weather here in the United States or elsewhere over the next couple of months. Something we need a trigger here to get this wheat market off the bottom. So switching gears from the markets, I want to spend a minute just on government programs, where we're at there. What we know about the SDRP, the Supplemental Disaster Relief Program, phase 2 of that program, I heard recently is supposed to now take place in October. Early it was going to be September. The phase 2 of this program is going to be focused on shallow losses. Phase 1 was where USDA calculated payments based on individual losses in 23 and 24. So phase 2 now is going to focus on things like ECO, SCO, margin policies. If you had a loss in any of those years due to shallow loss, then those would be the areas that they're going to focus on. Also, the government wanted to see how much money they had left out of I think it was $16 billion that the program had. They wanted to see that first round, they paid 35%. So they want to see what was left to be able to A, add to that first round of payments, and B, be able to implement a phase 2. So we expect that to happen probably within the next month. The other thing we're watching here this year is the PLC and the ARC program. And we talked all about the new programs under the One Big Beautiful Bill last month, that these are the new PLC reference prices in the dark blue box on the left. And then the next box over, these are the effective reference prices. And if you remember the discussion a month ago, under the One Big Beautiful Bill, even if you signed up for the ARC program last spring, they're going to basically wipe out your sign up. You're going to get the higher of an ARC payment or a PLC payment for the 25 crop year. Starting in 26, we're going to have to elect a program once again. But at least in 25, you get the higher of. And the ARC benchmark prices we used last spring, those are unchanged. Those are these dark red box numbers. 90% is the ARC trigger. So I took 90% here in this red box on here, the fourth box. Now keep in mind, ARC is a revenue program. So ARC is going to be looking at final yields times final price, whereas PLC is just a price program. So if your county yields are going to be better than the 5-year Olympic average going in this year, that would hurt your potential for an ARC program payment. So for right now, we're really focusing on PLC, and PLC using 442 corn. Right now, as of Friday's report, the government says the average farm price they project at $3.90. That would trigger a 52-cent PLC payment this year. The market year runs through August 31st, so we got a long way to go to get there. But if the price stays where it's at, according to the government, you'd be paid 52 cents a bushel times your payment yield at the FSA office times 85% of your base acres. Same with soybeans. We'd be looking at a 71-cent payment as of Friday's report. Wheat, drop that price 20 cents. Now you're at $1.25 a bushel. All of these crops right now would be triggering a PLC payment. So here's an example I recently showed. I updated it with the change in the price of beans. Let's say you're a producer in the Midwest. You got 1,000 acres of corn base, 1,000 acres of bean base. Let's say your payment at the FSA office on corn is 180, or your yield, and your bean yield is 60 bushel. Keep in mind, these yields were determined several years back. We haven't had a chance to update these payment yields in a long time, so they're probably going to be lower than what you're producing right now. But the formula for that would be to take the difference in the price. So on corn, that's 52 cents, times this payment yield, times 85% of your base acres. And in this example, that would equate to about $80, or about $80 an acre, or $80,000 here on corn. And on beans, it would equate to about $36 per acre. So nothing to sneeze at. And I would say that, from a producer standpoint, you've got a put option essentially in the market with the PLC program. So the fact that they raised those reference prices for PLC, the fact that the effective price went up as well is a big, big deal for us this year. And it's probably going to trigger some PLC payments, it looks like, here for the 25 crop. Just don't know how much. And the other thing is we have to wait to get it because we have to wait till the marketing year is over. And that doesn't happen until the end of August. So PLC and ARC payments get made likely in October of 2026 for the 25 crop. Now, estimates for payments. This is from the government. This is what they were estimating payment dollars to look like this year. This is not PLC, by the way. Well, PLC is included in here for the 25 fiscal year, but that would be for the 24 crop. So the big story this year are these other programs, supplemental ad hoc disaster payments. This is the payment dollars expected to go out the door. The last time we had a year like this was pandemic assistance. This was China trade assistance, et cetera, that we had back in 20 and 21. So in 22, I guess, was when the Chinese money hit. So this year expected. Now, going forward, this was from the CBO. This is what they were projecting a couple of months back when the big beautiful bill came out. For the 26 program, a lot of that money expected to hit in 27. So they were expecting, a big jump in payments in 27. I think in 26, they don't have that on here, but I think we're going to get some big money here as well. So time will tell, but if the prices stay where they're at, then we know we've got some help from the PLC program. So lastly, slipping over to crop insurance. What's going on for the 25 year right now? We've got several states in the South setting harvest prices as we speak. We're about halfway through the month. You can see that with these harvest averages, 421 on corn, 414 in Mississippi. We're down 11%, 10, 11% on price. Rice down 16.5%. So what that means is, if you've got a 95% policy on these crops, you could still trigger a loss even without a bushel loss because, if your bushels come in unchanged for the county, then because of the drop in the price, you could trigger some payments. For a crop like cotton, 3.8%, you'd have to have a bushel or a yield loss as well to get to, say, a 10% loss for the stacks program. So we'll see. But all these markets are down, just some are down further than others, but not enough on their own, in some cases, trigger payments. So we'll set prices in the northern states starting in October, and we'll be watching and see what the markets do there. I'll report those every day with the market report. I send these tables out every day with the updated prices in them. So looking ahead to 2026, first thing we're looking at is winter wheat coverage, and I believe the prices are final. We'll find out here in the next couple of days, but you can see the average prices on July wheat here for Chicago and Kansas City, September wheat for the northern states, 570s. Those are down a little bit from a year ago. So those would be the numbers we use for your revenue policies. If you buy just yield only insurance, we'd be using those numbers as well. We have a new program for this coming year that I talked about last month. We'll talk about it again today, called Margin Coverage Option. MCO is a new program that somewhat mimics margin protection, and it somewhat mimics ECO. So it's kind of a combination. MCO, Margin Coverage Option, is a margin policy. It's based on the area or the county, and it covers 6 different crops, and you can see which states it's available here for the 2026 season. We are setting prices right now for not only the crop, but also the inputs as well. And so those will all be finalized here in the next couple of days. Margin coverage option is a little bit similar to margin protection, and it uses a set of variable inputs that are based on market prices or wholesale market prices. It uses urea, DAP, diesel, and potash. It also uses natural gas for irrigation if you got irrigated ground in your counties. It does not use a fixed number or an interest rate number like margin protection did. So these 4 commodities are setting their prices right now, the base prices for the 26 year. Then we'll compare that to the final price that gets set average during the month of April, and to see whether there's a change up or down or sideways in these input prices. And so the first thing we want to do is compare MCO to margin protection, because they're both the timing is the same. Both of these are setting prices right now. And so both of them have a sales deadline at the end of September. And so how do these two products work? Is MCO going to replace margin protection? Well, margin protection is still available. Margin protection, I think, is still the Cadillac product because it protects total dollars from 95% down to where your individual policy kicks in. So you don't have any gap in dollars there. MCO is a banded coverage. It's 95 to 86% band. The big difference here is that the subsidy for MCO is going to be at 80%, where margin protection doesn't change. It's still going to stay at 44%. So MCO is going to be a lot cheaper. MCO does not have the protection factor. MP did have the 1.2 factor. So if you had a loss, you could get paid $1.20 for every dollar lost. MCO is dollar for dollar. MCO, you don't have to worry about the premium credits. With MP, we had to factor the premium credits later on in the spring, figure out how much credit you got, what that, essentially would afford you to buy it as an individual policy. We don't have to worry about that with MCO because MCO does not overlap your individual coverage. It's just that band at the top from 86 to 90 or 95%. So I think for most producers, MCO is going to make sense because of the cost, just because of this 80% subsidy. So then we're now comparing MCO with these other banded coverages and really with ECO, because ECO is a similar band. It's using the same band of 86 to 95. It's got the same subsidy level. The differences is that MCO sets its base price now, ECO does it in February. You have to decide to buy MCO now versus ECO in March. MCO includes variable input costs. ECO does not. So if you think costs are going to go up between now and April, then that would favor the MCO policy. If you think prices are going to go down between now and April, then that would not be favorable to MCO. And so those are really the differences. But to me, it comes down to what do I think price will do between now and February? Do I think price is going to drop between now and February? And if I do, then maybe it makes sense to use MCO today and get something locked in for next year. Now, the SCO, you can do that with either one of these products. SCO is going to start at 86 and go down from there to where your individual policy kicks in. So let's say you're buying 75 or 80% RP coverage. SCO would cover from that level up to 86. And then either MCO or ECO would cover 86 up to 90 or 95%. So this is what essentially you're going to be able to do now. If you don't do margin protection, like some have done in the past, if you choose between MCO and ECO, then this top box up here is that choice. It's either MCO or ECO. Then you've got SCO, supplemental coverage from 86 down to where your revenue protection policy kicks in. So it's kind of like, when you go to the restaurant, you decide I want to get this, and then I want to add hash browns, and then I want to add a dessert on top. That's kind of what you're essentially doing here with these policies going forward. So again, we don't have the tax credit or the premium credits that we do with MP. We don't have, so it makes it a little bit simpler. So here's where we're setting prices right now. These are not been finalized yet, but corn running 456, beans running 1073, spring wheat running 634. You can see where the inputs worst. Urea is running about $100 or $90 higher than a year ago. DAP's running $140 higher than last year. Diesel about the same. So potash is running about $100 higher than last year as well. So what that tells us is that our margins are not very good right now because we've got high input prices. The corn price is up 16 cents from a year ago, but not enough to offset that number. So here's where the market is and for December 26th corn. And so to me, it boils down to, do I want to lock in a margin today using 456, or am I willing to wait until February? What do I think is going to happen in the month between now and February? Do I think corn's going up, down, sideways? What's the risk? Well, last year we had a margin protection price at 440. The ECO price in February was 470. Here we are, 456 right now. The market is trading about a dime above that level here this morning. So if you're not fearful of the corn price going down, then maybe it makes sense to hold off and wait until February. Uh, I'm kind of in that camp, but I could be convinced that locking something in on that top 9% band is not the worst thing in the world at 456. And if something weird happens, if the U.S. and China get into an all-out trade war, if acres don't drop next year of corn like we think they might, and corn price does drop, then at least you've got something protected. The SCO and the RP policies won't set their prices now. This is just for that MCO ban. The rest of your insurance will set the prices in February. So, but as of this moment, I would probably lean towards waiting to do ECO in February, given my bias to the crop of this year's crop size getting smaller. I think going forward, I think we've got good export demand right now that's going to hold the demand base in place. So I don't think we've got a big risk of a huge sell-off. Now, that said, the RSI and stochastics are kind of overbought at the moment. So wouldn't be a shock to see us sell the market back down, maybe back down into the 450s. Cotton, had a couple questions last week about cotton. Do you want to lock this in today or you want to wait till February? I don't see a big risk. Last year, 69 cents. Right now, we're averaging 69 cents. I don't think 69 cents is a great number to lock in this early in the marketing year. We've got the RSI and stochastics pretty neutral at the moment. I would think if a trade deal gets done, we're looking at some better prices down the road. So I would probably hold off on doing this on cotton for this year. Soybeans are the crop that I'm looking at. And I wrote a column a couple of weeks ago, my 2 cents, had that in the market report for a couple of days of why I think beans might be the crop to look at. First of all, if you look at where we were a year ago at this time, 1040 and 1054, our insurance price right now, we're about 20 cents above that. Looks like we're going to start at about 1073 for MCO. Market's trading a dime above it here this morning. But a couple of things I think could be bearish to beans. Number one, we're going to probably plant another huge record bean acreage number this fall in Brazil. We'll see what kind of crop they have. Number two, I think U.S. bean acres are going to jump dramatically next year. I think we're going to flip corn back to beans. I don't see a big incentive to plant corn on corn next year at this point. So we rotated last year a lot of bean acres into corn. I'm guessing we're going to rotate a lot of those acres back into beans, especially with high input costs. And because corn margins don't look very good right now. So those two reasons alone, I think, tell me that bean stocks in the world could potentially grow a lot in the year ahead by the fall of 26. The third reason that you might do this is just China insurance. What if we don't get a trade deal done? And the market just continues to be disappointed by that. The funds trade beans from the short side. We get bean acres planted in Brazil this fall, and we just go forward without China in the U.S. market. Whether we need them or not, I think that's another story. But I do think that emotionally, I think the market is watching this pretty close. Traders are waiting to see if China buys. If we get out of these trade talks this week without a deal done, then maybe things, kind of fade back a little bit. So I think beans make some sense to consider. And keep in mind, this is only on that top 9% band. It's not on everything from 86 down. You'll have to insure that using the spring price in February. So we're just talking that 86 to 95 band at the top. So again, what do we think is going to happen to the acres? Well, the University of Illinois Farm Doc put this out recently. This is their projection on farmer returns next year. Even with the added payments from the One Big Beautiful Bill, PLC and ARC, ECAP payments, they still think that we're looking at negative returns on a 50-50 corn-bean rotation. Most of that's in corn, of course, because of the higher input prices. If you look at their numbers, look at the high productivity ground in central Illinois. They're looking at a negative $82 in corn versus positive $18 on beans. So I don't think Central Illinois guys are going to rotate a whole lot of acres, just switch to beans but I think it tells you what we're seeing throughout the country. And I do think that those corn acres, in a given rotation, we're going to see a shift from heavy corn to heavier beans next year. So I did a what if balance sheet here, and I said, what if we flipped the 6 million acres this year that we went from beans or went away from beans back to beans? Go back to 87.1 million acres. And if you use a trend line yield of 53 bushels with good demand, I used better demand numbers than what USDA is using this year, then you're still looking at ending stocks potentially, 450 to 500 million bushels out into 27. So what's that mean for price? Well, the last time we were at a 470 carry out in beans, we had average farm price with an 8 number in front of it. So I don't suggest we're quite going back to 850 beans, but you could certainly go back into the low 9s given this type of scenario, especially if Brazil has a good crop next year. And so we put together our margin coverage indemnity worksheet to kind of be able to walk you through the math and some of this stuff. And I said, what if this particular county, we start at 1073, what if we go to 950 beans next fall? And what if the input prices for beans stay the same? We don't have urea in beans. We only have 3. We have DAP, potash, and diesel fuel. What if those numbers stay the same between now and April? And what if the county yield stays unchanged next year? Well, the band, that 9% band, in this example is 70 bushel APH, would be worth the higher the prices times that APH on the farm times 9%. So that's a $67 band. And if your inputs stayed the same and the county yield stayed the same, just because of the drop in price to 950, you're looking at about a $45 indemnity payment. So not quite the whole band, but considering what the cost of this thing's going to be, it looks like pretty cheap insurance. I'll show you that here in a second. Looking at the matrix, it'll walk you through all the different scenarios with yields across the top, prices on the left-hand side. If you were to bump down into the 8s, down here with 100% of a normal yield, you'd be maximizing your 9% band. And so I'm looking at this as insurance, of course. It is insurance. I'm looking at it right now as price insurance. And for beans, I think it does make a little bit of sense. So I put together this T-chart recently to be able to kind of look at the positives and the negatives, kind of focus this a little bit on corn, but I think the advantage to MCO on any crop right now is you lock in a worst case scenario on the top 9% of your revenue from 95 to 86%. You can't take that away from you once you lock it in. If you don't lock it in today, you're susceptible to what can happen in the next 6 months, whether that's with South American crops, whether it's political, whatever the case is. We've got some very large carries right now. That's why those market prices out into 2026 are as good as they are, because there's a big incentive to carry old crop to new crop. And so those new crop prices are quite a bit higher. Corn has had a history of having better prices this early period. Beans have not. However, this year, again, we've talked about the reason why we might want to consider beans. It's a whole lot easier than hedging or cheaper than buying put options, buying MCO right now if you want to get something locked in for next year's crop. The disadvantage, especially for a crop like corn, is that we have the lowest insurable margins in 5 years because we have high nitrogen and DAP prices. That's hurting the margin. So it doesn't give a lot of incentive to buy a margin policy when margins are tight. The funds still hold a large short position in corn. ECO should be a little bit cheaper than MCO for 2 reasons. Number one, you don't have the time value, because right now MCO, you've got 15 months between now and next, or 13 months between now and next October, where prices can move. ECO from February to October only has 9 months, 8 months. So you don't have time value in ECO like you do in MCO, and you don't have the input prices in ECO. Both of these have an 80% copay. The government's picking up 80% of the cost of these policies. Both of these are banded coverages. You can still buy SCO and RP with both of these policies. The biggest question, I think, is do you think there's a good chance of a big swing from corn to bean acres next year? And if you do, then that probably would give you your best idea of where prices could go. That maybe if you think that's the case, then beans probably have more potential downside. Corn probably doesn't have as much potential downside based on that opinion. So this was an article I put in my market report a couple of weeks ago called My 2 Cents. I wrote the reasons why I think, and a lot of it we just talked about, why we think there's a potential for the beans to go down. You can see here the actuarial data on this particular date, that the producer premium for MCO on beans was less than $7 a bushel in this particular county. And so the unsubsidized or the total premium would have been up about $34, $35, somewhere in that neighborhood. Producers only paying 20% of it. On corn, the total premium is running around $50, give or take, in the I states. Producer premium is going to be 20% of that. So MCO, ECO, these are all going to be helped out a lot this coming year by the government. But this just, to me, makes it a little bit easier to make that decision of, man, maybe MCO makes sense. I'm only investing $6 or so to lock in that top 9% band of revenue as an insurance policy against added acres or against China not buying U.S. beans. Maybe it makes some sense to consider. Also, I would encourage you to go back and check out the Revenue IQ letter that we put out at the beginning of the month. I recorded a thinking cap video on margin coverage option as well out on our YouTube channel. You can go listen to it. Things haven't changed a whole lot since the beginning of September, so I would encourage you to give that a listen if you get a chance. Also, want to mention our tools that we have for the agents that are online listening. If you go to the agent portal, go under resources, down about halfway, indemnity and profitability worksheets. If you click on that, it'll take you to the page that shows all of our different worksheets. The margin coverage worksheet option I just showed you. We've got several other ones as well. One that I want to highlight at the moment here is the producer profitability matrix, because I really think that going into 2026, kind of like we did in 25, but I do think that this is a great worksheet to be able to work with a farmer who's considering, who's concerned about profitability, concerned about how the policy might be able to help them out this coming year. And so this is, I didn't go in and change the county yields. This was an example I had from last year, but I made a couple of tweaks to it. But this is a corn producer in McLean County, Illinois, with an APH of 230. His expected county yield was 226.8. I said the base price ends up being 456. Actually, December corn next year's higher than this right now. And I said that we buy an 80% RP policy. Then we add SCO and ECO on top of that. Now, the big difference for 2026 is that the decision to buy SCO is decoupled from your farm program election. So you could still do anything at the FSA office and still buy SCO this year. So that's new. So last year, a lot of people didn't buy SCO. This year, because it's going to be subsidized at 80% also, makes it really seem like I hate to use no-brainer, but it seems like a real easy decision to go ahead and add those two to get your dollars of coverage up to 95%. The premium, the insurance premium is going to be a lot cheaper because of the added subsidy from the government. I used $1,000 in inputs, said that we contracted 50 bushel an acre at $4.50 corn. I've got a spot in here where I can plug in PLC payments as well. So if you think you're going to get a PLC payment next year, I meant to use the number I used earlier, but I said $88 an acre, then the matrix down here shows you your combined revenue, your net revenue after your input costs are deducted. And so you can see here that, in this example, 80% RP with an SCO and ECO, and adding that $88, doing a little marketing, at $1,000, I'm making money under every circumstance for next year. Now, maybe your costs are going to be higher than this. Maybe you're looking at $1,100 or $1,200 an acre on rented ground, and you can plug that in and see what the impact is of doing all of this. The other thing you can do on here below the printed page, this is our printed page. Below there, it's going to show you each of the calculations. So we've got a calculation matrix for the revenue protection policy, for the SCO, for the ECO. So you can look and see how those products would have stood alone, where they would be triggering a potential payment. Also, if you were to pan down, it's got the marketing, your input costs, etc. So I think this is a great tool to look at. Again, for the agents or even farmers, if you're a producer listening and you want to talk to your agent, you want to see this, let us know. We can do that. So coming up, what do we got coming up? Well, we've got our quarterly grain stocks report on September 30th, coincides with our crop insurance deadline for the fall policies. That would be on winter wheat coverage. That would be on margin protection. It'd be on margin coverage option, the new MCO policy. If you're interested in looking at that on beans, you've got another 2 weeks to get that done. October 9th is our next USDA report. I guarantee USDA will be tweaking some numbers in that report. We'll talk about it on the 10th in our next aftermath webinar. The 13th is Columbus Day, which is always an unusual day because the markets are open, but the FSA office is closed. And so back in the old LDP days, that used to be a big day when the market seemed to have maybe made their low, and a lot of farmers would turn in their LDPs. And so just kind of an unusual day. The 10th and 11th, we'll do our next crop reports again and aftermath, and then we'll have our Thanksgiving holiday on the 27th. The markets will be closed that day. So with that, we thank you for listening to this month's edition of the Aftermath. Hope you have a safe harvest. I know a lot of people getting started. We'll be monitoring the harvest progress reports as we get them. We'll have another one here Monday afternoon and be looking at those and see how we're doing. So with that, have a great one, and we'll talk to you again very soon.